Welcome to another episode of Whiskey and Wealth. Last time we talked about what an index was and how to gain exposure with an index using different funds, such as mutual funds and ETFs. Today we're going to talk about what is a mutual fund or an ETF. Stay tuned. Now, mutual funds and ETFs, which stands for Exchange Traded Funds, can do many different things. And I mentioned previously that they are used to track indices or indexes, such as the S&P 500, but they can do many more things. You can get mutual funds or ETFs that track bonds or commodities or have active investments. They can follow certain sectors or invest in certain sectors, currencies, and so on. So they're not just meant for passive investing. Now, a mutual fund basically gives an investor easy access, and ETFs as well, easy access to a basket of investments. So instead of an individual investor going out and purchasing every single stock in, let's say, the S&P 500, you would just simply buy a mutual fund or an ETF already wrapped up with the investments you want exposure to, and buy that one fund which gives you exposure to the strategy or the index that you're wanting to gain exposure to. Now, this spreads out your risk rather than holding individual companies within your portfolio. You can hold different strategies, different indexes, different commodity indexes, currencies, and so on. And the last little piece of information on mutual funds and ETFs is a fairly big one, and you might have heard this before, but the difference between a mutual fund and an ETF is basically the way they're structured. And this is sometimes important if you're investing in a taxable account. The way a mutual fund is structured is that it passes capital gains from the mutual fund to the investor, which means if you're holding a mutual fund in a taxable account, you, the investor, are paying tax on those distributions. And without getting into the weeds, an ETF is structured a bit differently to where it doesn't pass those capital gains to the investor. So the after-tax return on a mutual, or rather an ETF, the after-tax return is potentially higher. Now, if you're investing in a retirement account such as an IRA or a 401k or different tax-deferred accounts like that, it's not as big of a deal when you look at mutual funds and ETFs based on their exposure to passing capital gains and their tax exposure. What you really want to be concerned with in a retirement account with a mutual fund and ETF is just the expense ratio. The expense ratio can be a lot more on a mutual fund than an ETF, but lately those expenses have come down as well. So that's pretty much the basics between a mutual fund and ETF